All right, welcome back. We've got an Amazon earnings video. It's been a couple volatile weeks in the stock market with a lot of earnings and a lot of stock movement, a lot of volatility. So one of the big names that had the biggest moves was Amazon. So we're going to talk about the current state of Amazon, the recent earnings, and why the stock has been moving so much, and if this is an opportunity in the making here. So Amazon is currently at 198. Market cap is $2.1 trillion. Market cap is the value of the total value of the company. And its forward price to earnings is 25.7, and this is trading at its cheapest valuation ever. So Amazon is currently at the lowest valuation that it has ever traded at. It is down 23% from its all-time highs. It's not expensive, it's not cheap, but they need to execute for this company to continue to move up, which I have a lot of confidence that they'll be able to do. So they did just report their Q4 earnings for 2025. So the last 3 months of 2025, they reported $213 billion in revenue, and their earnings per share was about $2 per share, which is a 5% beat. So these are real solid numbers. Amazon Web Services, which is their cloud hosting business, is steady. It's growing at a fast clip, and it is still the leader in the whole industry. Advertising is doing really, really well, and their gross margin is looking very solid. So overall, earnings was great. The reason the stock is down is because of their capital expenditure that they announced, which we'll talk about. But growth looks solid. So forecasting in 2028, they will eclipse $1 trillion in revenue for the year. So right now, they're just about $750 to $800 billion in revenue for the full year, which is unbelievable. And they're looking at, in 2028, to be the first company to reach $1 trillion in revenue for the year. All right. So profits come from Amazon Web Services. This is 15% of their revenue, but 70% of their operating income, and they make $123 billion a year on the cloud business. So most of their profit comes from AWS. They don't make a lot of profit selling you deodorant for $2 and shipping it to your house. They make pennies on that transaction. But if they sell you $10 worth of cloud computing, they're pocketing $7 of that transaction. So their margin is much, much higher for AWS, and obviously advertising as well. So advertising is growing at 20%. So this is their fastest growing market here, is going to be the advertising, and they have 50% margin as well. So when you go to Amazon and you type in deodorant, someone is paying Amazon to put their product up at the top. And that is a very effective ad. And that is definitely a business, because there's so many products that they're going to continue to milk that advertising business, as well as Amazon Prime. So the media part of their business, we're going to continue to see ads grow there as well. So those pieces of the business are looking really, really good. So now the big debate. So they did announce that they raised their CapEx guidance. I believe their initial guidance for 2026 was that they were going to spend $150 billion. They raised that up to $200 billion that they're going to spend in 2026. So the reason this isn't the best thing in the world is because it's going to bring down their profit, their profitability, and their free cash flow. So if they make, 800 billion, but they're spending 200 billion, they're going to have less cash on their balance sheet to do other things with. Cash, what they would do with the cash instead is buy back the stock, issue a dividend, things like that. So to me, this is better than buying back the stock or issuing a dividend. I would rather them invest into the future so that they can hit that $1 trillion revenue quicker. So where is this $200 billion going? You know it. It's going to AI and the data centers. So this is going to be their largest spend. The more data centers, the more training and inference, the more Amazon Web Service revenue, which is where they get most of their profit anyways. So they're going to double down on that growth, and the cash cow of their business. They're going to double down on that because there is such a demand for it, and that's where they make most of their money. So it doesn't make sense to spend $200 billion to sell you more deodorant, but it makes more sense to spend $200 billion to build out these AI data centers. So they're also going to be building their own AI chips that are lower cost than NVIDIA GPUs, and it's going to be powering their Bedrock model and Anthropic. So the big hot model right now is Claude. Now Claude is a product of Anthropic, and Amazon owns a big piece of Anthropic, and that is going to be their big customer for a lot of these AI chips and AI data center projects. So they already have many other customers, but they also have a premier rockstar AI company with Anthropic that is obviously only going to use Amazon for their AI needs. So these chips are going to lower the cost per token, more enterprise adoption, higher cloud usage, and reoccurring revenue growth. That's all good stuff. And the AI agent infrastructure. So AI agents will be running 24/7, ongoing compute billing, sticky enterprise contracts. The advancements that we're seeing right now in AI is so unbelievable just this last month or so, especially with Claude, Clawbot, all these AI agents that people are buying these little Mac minis and creating these own little agents to run tasks 24/7. And it's getting to the point where the price to run these little computers is getting into the hundreds of thousands of dollars because they're going 24/7 and they're doing so much complex tasks. So you're getting to the point where these tokens are costing the same amount as it would to actually have an engineer, but you don't actually need to have the individual. The computer's doing all the work as long as you tell it what to do. So there's some money to be made here for sure. Okay, one of the other projects is going to be Project Kuiper. This is going to be like a SpaceX Starlink competitor. So they are going to be launching these satellites up into space to create a broadband network to where people can connect to. So this is the best and largest SpaceX competitor out there, and they've already been launching these last couple of years. And this will be a very high risk, high reward opportunity. And last but not least, logistics and robotics. If you already see Amazon warehouses today, there's not a lot of people picking orders and packing boxes. It's robots moving throughout the floor 24/7, pulling your order, sending it over here, and a robot is packing it in a box, putting it on a truck, and then the truck is moving out, and a human will deliver it to your door. So they are already one of the leading robotics and logistics companies out there, and that is because AI and robotics, obviously. So they're going to double down on that as well, so they can keep giving you your deodorant on time at a cheap price. So the market doesn't like it. They want margin expansion. If they are spending more money and the revenue is coming down the road, in the short term, you're going to see their margin compress. Their profit margin is going to compress. But Amazon wants the long-term dominance, and I agree with that. Amazon for a very long time did not show a profit. They sold things at a loss or break even, and just to gain market share, and then eventually economies of scale, they can get their costs down, and then boom, next thing you know, they're the highest revenue generating company in the world. So I get what they're doing here. The market is short term, they don't like it, and it may take a while to see this 200 billion return its investment, but it'll be well worth it if they can do it. So why is this smart? Revenue reacceleration likely shows up in 2027 and 2028, and this is a build now, monetize later strategy. This is what all the big companies do. Uber, we're going to sell you a car ride for $10. Once we get you stuck in our network, a couple years later, that's going to be $15, $20. Then they can monetize that product later, but they want to get you now, build it now, monetize it later. All right, so revenue impact. We said Amazon Web Services right now, 123 billion run rate. Run rate means for the full year. If Amazon Web Services can grow to 200 plus billion over the next 3 to 5 years, their margin will move back towards the 35 to 38%. That'll be great. And ads scaling towards 80 billion. If they can monetize Kuiper, agent-based SaaS revenue with Claude and Anthropic, there's a lot of good things that could go right here for Amazon. Now, what could go wrong? AWS growth slows further. So Amazon Web Services is the biggest cloud company out there. Their competitors like Microsoft and Google, they are growing at a faster pace, but they're still much, much smaller. So they are growing slower, but they are still the largest pie out there. So if their growth slows a little bit more and their competitors continue to speed up, we could see eventually Google Cloud or Azure from Microsoft growing to be larger than AWS. But we're not there yet. So the other big potential mistake here would be if the $200 billion in CapEx does not produce return on investment, obviously. So let's go ahead and take a look at the chart. We've talked enough about what's going on with Amazon. Let's take a look at what the chart shows. So the chart shows here 9 red days in a row. We did hit an all-time high of 258 at the end of last year. We chopped sideways and we've been rejected multiple times at this 250 level. And ever since the earnings report, 9 straight red days, down 23% from the all-time high. And no buyers in sight here. This is just a free fall. So no one is excited to step in here because this CapEx that they're spending is going to hurt their numbers in the short term, the next couple of quarters, and it's going to take a little bit of time for them to recognize that revenue to get the stock to go back up. So sure, the stock can go back up on positive headline news, just the overall market going back up, but I expect this stock to be in the penalty box for a couple of quarters because it's going to take either a big headline or some drastic increase in revenue somewhere else to get the market excited. But for me, this is an exciting opportunity for the next year or so to be accumulating a high quality business at a discounted price. We've already talked about the numbers. This is their first earnings report in a long time that they did miss their earnings per share. They missed it by a tiny amount here. So the market doesn't like that. And they don't like that they're going to spend a lot of money. But long term, nothing wrong with this business unless those key pieces that we talked about really go south. But like we showed, there's many ways that it can go right and a handful that it can go wrong. I think those will balance out in the positive aspect for Amazon. So technical doesn't look so hot here. We're probably due for a little relief bounce back up over 200, and then we'll see if we can have momentum to move back up. I would expect something like this. We bounce back up, reject, come back down, eventually tap below 180, and then give it some time before it can get energy to move back up. So for me, Amazon is a dollar cost average here. This is an undervalued stock, and this is a market narrative that is being painted of what if the $200 billion doesn't work out. Amazon has bet on themselves many times in the past, and it has worked out tremendously for them. So Amazon, to me, not financial advice, is a buy right here. And obviously my next buy target is 185. And the lower we go, the better the discount will be, unless we get drastic change in revenue forecast, things like that. So the tricky part here for a company like Amazon and just the overall market is we are near an all-time high. So if the market does go through a 10 to 15% pullback, Amazon will also pull back 10 to 20 to 30%. So I'm not throwing all my cash that I have right now at Amazon, even though to me this is a very attractive buying opportunity. If the market does want to pull back, which to me it looks ripe for a nice little pullback, you're going to see Amazon at better prices. So for me, I'm going to be cautious. This is my second largest position overall, so I'm already heavily exposed here anyways, and I will be continuing to accumulate this name over the rest of the year. So long-winded video on Amazon. I hope this helps everybody, and if you got any questions, put it down in the comments, and we will keep updating everyone on Amazon quarter to quarter or headline by headline. So have a great weekend, everybody, and peace out.